Hello and welcome to Moneylife News and Views. I'm Debashis Basu. India's two leading stock market indices, Nifty and Sensex, have delivered zero returns since September 2024. It's 1 year, 9 months now. So, viewed through the lens of its largest companies, Indian companies seem to be struggling. But what if you looked instead at its smaller firms? A different picture emerges, one of vigorous growth, expanding profits, and buoyant demand. The contrast, noted in a piece I wrote in late February, where I said small caps a silver lining, has not only persisted but become more pronounced. In March quarter, operating profit of Nifty 50 companies rose by just 4%. So the struggles of large companies is continuing while net profit increased by just 4.5%. It was the eighth consecutive quarter of single digit earnings growth of Nifty 50. By contrast, companies in the broader Nifty 500 index delivered an operating profit growth of 9.2%, while adjusted net profit jumped 16%. What makes this divergence more striking is that both groups recorded sales growth of roughly 11 to 12%, but the smallest firms were able to better protect their margins, absorb rising costs, defying the conventional wisdom that scale confers resilience. Everybody believes that if you're larger, you can withstand more, you can do better in times of problems. But that is not the story that's unfolding here. The dominance of India's largest companies is gradually eroding too. Their share of profits of all listed firms have fallen steadily from 51.8% in March quarter of FY25 to 49.8% in the preceding quarter and 47.1% in the latest one. As in the previous quarters, the most eye-catching performance came from microcap companies. Their sales rose by 17.5%, while operating profit increased by more than 22%. Even these figures probably understate the strength of the segment. Many of the fastest growing and highest quality small firms remain outside the benchmark of the smaller companies' benchmarks I'm talking about that investors follow. The persistence of such strong performance is surprising because the broader economic backdrop has deteriorated. Net tax revenues fell by 6.3% last month, largely because of softer goods and services tax receipts. Yet, many small companies continue to flourish. What is going on over here? The explanation lies in a shift that received little attention outside the community of analysts and keen eyed investors. India today has an unusually rich ecosystem of listed smaller companies operating in sector with powerful and long lasting growth drivers. Pharmaceuticals, engineering, capital goods, defense, and power infrastructure are among the most important. India's projected peak electricity demand is expected to approach 460 gigawatts by 2032. Meeting that requirement would need vast investments in transmission infrastructure, including more than 120,000 circuit kilometers of new lines, additional substations, and a gradual grid upgrade from 220 kV to 400 kV and to 765 kV networks. The theoretical requirement runs into several lakh crore rupees. Not all of that investment will materialize. Inefficiency and delays are unavoidable. Yet, even if a fraction of the planned expenditure represents an enormous opportunity for the small cap companies that manufacture transformers, switch gears, circuit breakers, insulators, voltage step regulators, capacitors, protective relays, cables, and smart meters. Now, there are large companies at the higher end, like BHEL or Hitachi or uh, Siemens, but many of these, the middle ones and the smaller items, are all manufactured by the smaller companies. Second sector, pharmaceutical services. Now, not pharmaceutical products, but services. This constitutes another powerful source of growth. India's contract development and manufacturing organizations at CDMOs and contract research and manufacturing organizations at CRMOs have evolved from low cost suppliers into strategic partners for global drug companies. Estimates place the size of Indian CDMO market at 19 billion to 23 billion, with growth rates of around 12% annually. The better ones are growing at 20 to 22% annually. And this will probably sustain for many years. Indian facilities can often be commissioned far more quickly than their Western counterparts, and they operate at costs that are 70 to 80% lower. India also has the largest number of US FDA compliant manufacturing plants outside of America. This is not an industry dominated by pharmaceutical giants, it is a knowledge intensive business in which smaller specialized firms are often at an advantage. The third, rather, data centers. Demand for digital infrastructure continues to surge, and the sector is expected to expand by around 30% this year. The union budget for 26-27 sweetened the proposition by offering a tax holiday until 2047 for eligible foreign cloud service providers. Globally, investment in data centers is expected to exceed 180 billion in 2026. The benefits mainly accrue to suppliers of various gear, power equipment, cooling systems, cabling, and other supporting infrastructure. Here again, most of the beneficiaries, or many of the beneficiaries, are small firms. Fourth, engineering, that is capital goods and defense, and railways partly. Government capital expenditure, defense indigenization, rising demand for precision tools, factory automation, and export opportunities have combined to create a sustained expansion cycle. Many firms expect double digit growth for years. Several already possess order books stretching 3 years into the future. Most will remain well below the radar of big institutional investors, especially the foreign ones, because they do not buy small companies, and this is where the opportunity lies. Fifth, services, different kind of services. For decades, listed services companies were largely synonymous with software exporters, but rising income, urbanization, and aspirations of a wealthier middle class have given rise to a growing area of listed domestic services businesses. What are these? Finance, wealth management, asset management, brokerage, insurance, depositories, registrars, exchanges. 2. Healthcare, diagnostics and hospitals. 3. Retailing, app delivery, retail chains, online stores. Every year, dozens of new services businesses are entering the listed space. Most of them are small outside and remain outside the indices. India's macroeconomic challenges remain formidable. The fiscal position is under pressure. In April, subsidies rose by 52%, driven by higher food and fertilizer support. Interest payments increased by 18%, while other expenditures surged by 27%. Such pressures will undoubtedly affect some businesses, particularly those dependent on government contracts or discretionary public spending. But despite two major external shocks, America's punitive trade tariffs imposed last year and the 3 month closure of Strait of Hormuz, demand is robust and order pipelines intact. The remarkable rise of small caps, therefore, reflects the emergence of a broad set of specialized businesses operating in industries where sectoral tailwinds remain considerably stronger than the macroeconomic headwinds. That is a story now of the rise of smaller companies, and it will remain so for a few quarters at least.